Sorry, ladies and gents.
Oh.
Hello, Dan. Hello, Dane. It's just the three of us for now, gentlemen. How are you both?
Good. Very good.
How are you both? Good.
Mate, I'm feeling really good because I won't be here next week, ladies and gents, because I'm going fishing tomorrow for 10 days. So, ladies and gents, if I don't send you a message personally and I don't reply to you for the next 10 days, it's because I'm fishing. Come back to the Facebook Live. That's where you get all of the useful info.
So
10
good.
days.
So
Who
good.
proved that, Robbie?
Mate.
Mate, you know what? Work isn't even the hardest one to get that one through. Like, somehow my wife said I was allowed to go fishing for 10 days, and that's probably a bigger coup than getting a work option out.
Was that
100%.
family-less? Wow.
Yeah.
Wow.
Ken Herman's in the house. Sammy Wynn's in the house. CJ's there as well. Tim McGregor, Tamara, and Ben are hooking up. No, not hooking up. They have hooked up. Sorry, they're in the same location down in Canberra. Bettina Ryan's in the house. Bettina, let me know how the sale of your house went, buddy. I want to know. We need to speak soon. Dom Grigor's in the house, brother. You are looking good on the Instagram. Jai Simmons in the house. Nicky Otto, Luke Hughes, and Beck Henson's there as well. Got to meet the lovely Tamara. Yes, awesome. And Kelly Marie. Now,
Man, what a crowd.
before we go any further, for the record, Miss Kelly Marie, that rocky road that you passed in onto the crew, of which bloody Hayley was protecting with her life and chopped it up so all of us got more than one piece, is the best fucking dessert of anything I've ever had in my life. It is up there. It is. I may or may not have had more than 3 or 4 pieces
At once.
today. It's so fucking good. And Kelly, thank you so much for sending it in. I know the team are absolutely stoked to be walking around bloody stuffing their faces with that. So yeah, awesome. Sophie Grove's in the house. Debbie is here as well. Oh, she's giving away who our bloody special guest is going to be.
It was advertised.
It's advertised.
It's okay.
I know it was. Gordon Spooner, you're in the house as well. We got a big bunch of people here tonight already because what we're going to be talking about, ladies and gents, is everything to do with tax. As we know, when you have your own home and you're living in that home, first of all, you're slugging away at your own mortgage. You're stuck in the 30-year mortgage trap. If you're not concurrently investing, you don't have a wealth creation plan. And oh, by the way, the rates, the insurance, the interest on the loan, any maintenance that you do, body corporate, if that's applicable, whatever it is, when you're living in your own home, Dane, give me a fucking big fat donut. How much of that is tax deductible? 0. However, when you have an investment property, the interest on your loan, the property management fees, the insurances, the water access, fucking maintenance, et cetera, how much of that is claimable on your individual tax return? What's the opposite of a donut? Everything.
I was saying that then.
Everything is claimable. So I guess it's really, really important, Dan and Dane, in all seriousness, as you guys know, an investment property has 2 forms of guaranteed income, a rent return and a tax return. And as the great Robert Kiyosaki speaks about when it comes to wealth creation using the property asset class, an asset is something of value that provides you an income stream. So that, ladies and gentlemen, means that your own home that you're living in that takes money from your bank account every month and provides you no level of income is not technically classed as an asset when it comes to wealth creation, but certainly when it comes to investment properties, then you have your 2 forms, bang, you're in the game and away you go from there.
Mate, I literally was talking about that 2 days ago in the office, and
Right.
one of the crews, I'm talking about their house and the structure, and they're like, yeah, I'll get that, and I'm like, that is debt, that is bad debt. You're paying that off, mano a mano with the bank, and just a stark reminder that everyone gets to it one day. They have a loan and they're going one-on-one with the bank, and that is not tax deductible debt because it is not paying itself off because you're the man that's responsible for that one. So,
and look, I get it, right? And all of us now are homeowners.
Yeah.
But we have the right mindset. Our axons are firing correctly, right? Trying to tell another homeowner that was sort of just come in contact with us that the debt against their own home is actually bad debt. It's like, what do you fucking mean?
Yeah.
It's my own home, mate. It's fucking going up in value. I'm paying it off. I'm going to be mortgage free one day. Like, listen, fuckface. It's bad debt. And I didn't even name anyone, so it could be anybody that I'm talking about. Anyone who thinks like that needs to think a different way. So away we go. All right, it gives me absolute pleasure to introduce this bloke. Not a first time attendee on these lives. Not a first time attendee in our office where we used to like get the camera set up on the back of the fucking old coffee box and everything. This man has been in my life for the better part of 6 or 7 years. He runs all of my financial affairs. He runs the financial affairs of the business, our self-managed super fund, my own personal stuff, and certainly everything that goes on with our tax. When we talk about having skin in the game, ladies and gentlemen, and we introduce it to our, the builders and the property managers and the building inspectors and the insurance agent and all those people that you guys have now listened to on season 2 of our podcast, they're all well and good, but I tell you, there is one person that will have your balls out of a sling if you find them in a sling, metaphorically speaking, ladies, don't wince, that can basically protect your ass when it comes to wealth creation, put an awesome plan in place to make sure you're not paying so much tax, and just make you feel so much fucking better about your financial future. He's the myth, the man himself. Bring him on, Jace Cosgrove. My man, where are you? Golf clap, everybody. Bring him up, please. Maybe
mate, I don't know how I don't know how I live up to everything you just said, mate. You nearly brought a tear to my eye. But, mate, 5 minutes ago, you're talking about tax deductions. Probably, I've got nothing else to add. I mean, we're 6 minutes in and we're done, mate. You've covered it all.
No, mate. There's no bullshit about anything I just said. It's all about the tax advice, the wealth creation advice, the moving of money around sort of Tamara and I's portfolio, and everything you do for us and all of our clients is really, really, gratefully received, mate. So thanks for being you. And, when it comes to all things tax and all things wealth creation, there's no one else that we point, that I go to, that Dan goes to, that Dane goes to, and everyone else in the whole bloody Axon family goes to, and certainly all of our clients as well. So, mate, what are you here to talk about tonight?
Mate, we've got some tax time tips tonight. The end of financial year is upon us, mate. So we're here to talk about tax time. So, we'll get through that, and I guess we can talk about everything that I do. Like you mentioned there, not just the accounting side, but the wealth creation and things like that. So if we've got some time, mate, we'll talk about some of the improvements that I've brought into the processes that we do. So it really is.
Mate, I absolutely do want to spend the last 7, 8, 9, 10 minutes of tonight's session because, tax is tax. And, like I sort of said before, own home, claim nothing. Investment property, claim everything. Certainly we're going to talk about at-home tax deductions from a COVID perspective. I know you've got an awesome slide there about from all of our serving members in the Defence Force, what their sort of work-related specific, claimable sort of deductions are, and an awesome little slide that talks about what everyone's rental property deductions are. So we're going to go through that in 20, 30 minutes, no dramas. Yep. And certainly, ladies and gents, as you can see, Noah there, make sure you do send in your questions. This is your opportunity now where you've got, and we put this on our little process and risk management plan. Don't just go to an account when you have an investment property, when you have an investment portfolio, and when you're talking about getting 8, 9, 10, 11, 12, 15,000 bucks back in your tax every year based on smart investment decisions. Don't just go to someone on the corner where you pay $100 to go get your fucking tax return done. You've got to have, there's a difference between an accountant and a property savvy accountant. I'd love to know, just sort of question without warning, mate, like, when did you really get into sort of, learning and understanding and become like, what I would consider an expert accountant in the sort of property market as well as all the other asset classes? Because not everyone sort of does what you do.
Mate, look, I don't know. It was it's me and numbers, mate. I've just got this thing with numbers. I love numbers. We talked about it in the podcast we did, my little fascination with numbers. Yes. But it's like tax, you've said it correctly. Tax is just tax, mate. There's not much to it. The reason I like I guess that the reason I like the property side of things is because you're actually talking to people about a future plan that they've got, and you're bringing in this all-encompassing process in, whereas a mum and dad group certificate, maybe some dividends, maybe some interest, maybe some deductions. It's like, big deal. There's not a whole lot to it. But when you're bringing in rental properties, it adds a level of excitement, for the client. It adds a level of excitement for me. You mentioned the dividends. You mentioned the refund. You mentioned the 2 forms of income. It's always pretty exciting when you're talking to people, 1, about getting a good refund, or 2, that they've got tax to pay because they've made a lot of money, in the journey that they're on. So it's a lot more of a fun. It's a lot more a dynamic process, mate, doing tax returns for those people, but mate, probably more so for your clients. You know, your clients and everybody on here. I know the names. You guys are a pleasure to deal with. Off the bat, you know, if we talked about you guys yesterday in a team meeting we had. You know, excellent clients. My wife Natalie does a whole bunch of the returns. I'll stop waving my hand.
I do it all the time, bro. Dude, go yard.
The most I've ever had to wait for a query back from an excellent client is like the next day. You know, so it helps when we're dealing with your guys. Now I throw my pen away and I want it, I can't find it. We've, you know, it's just a pleasure to deal with you guys, mate. It's a pleasure to deal with your team. It's a pleasure to deal with your clients. I can't speak highly enough of the whole freaking lot of yous.
Feel the love on the call tonight, Dan.
Yeah. I mean, there's probably some people in the background that threw their pen away as well as you did then, Jace, when you were like, actually, ladies and gents, you might have to pay some money back. You might have to give more tax on that. There's probably sitting in the background, mate, going like, this is bullshit. I want to get money back from the government. Why on earth would I have to pay more? I suppose, can you just give us some sentiment around that, mate? Why might people actually get to that position where they're giving more money over to the government?
All right. So I every Friday I send out to my clients the Friday wrap. So it's about a 5-minute video. So last week I did one saying we sort of got to tax time and I started to bring some tax time, you know, process in. And I said, you know, in the subject, you want to pay more tax. So the amount of people that walk into my office and go, I don't want to pay any tax, to which I reply, you want to pay any tax? Mate, I want to pay $3 million in tax. And they're like, what do you mean? I go, if I pay $3 million, it means I earned $6.8 million. If you pay no tax, it means you got a taxable income of 22 grand. Like, who would you rather be? You know, and so for me, it's about the mindset. You know, I very much believe, you know, and through 41 years of practice and succeeding at this, I build what I can see in my mind, and I'm very careful of what I say and the words that I let sort of talk to myself, you know, in that general chat you have with yourself, because I feel like that's what's going to become my reality. So I say, if you don't want to pay any tax, you're putting out there that you don't want to, you know, earn any more than 20. If I pay $3 million, it means I'm going to earn 6.8. And I'd rather, like, paying tax is a good problem to have. You know, Robbie, I've had the chat with you last week, mate. You know, paying tax, as much as it's a pain in the ass, you would not rather have the alternative of not paying tax because of the income you're earning, you know? So build
it'll make my eyes water again.
Yeah. You want to claim every deduction you're entitled to, and we'll talk about that in the presentation, but you want to earn a shitload of money and pay a shitload of tax. That is just, why wouldn't you not want that frame of mind?
That's the way it is. Yeah, awesome. Mate, we've got a couple of questions straight off the bat. I know you've got a couple of really simple to understand slides we're going to go through, but yeah, certainly. Let's go to Benny Hinton straight up. Actually, no, Will Grigor. So this is an easy one, right? Can you claim tax on your trips to visit your property interstate? Will and his husband, Dom, live over in Perth. Yep. They're now building their first investment property here in southeast Queensland, and he's like, fucking beauty. Let's go and see the boys and girls at Axon, and I'm going to write it all off on tax. What's the go there, please, Jace?
No, mate, not anymore. A couple of years ago, you could. Yeah. And I think they sort of figured that people were using it as a bit of a rort, spending 2 weeks in Queensland, 5 minutes with their investment property.
Robbie Turner.
Maybe it was their property in Cairns that they were going to visit, mate. I'm not sure. But that little little rort has been stamped out. So unfortunately, you can't claim the cost of travel to go and visit an investment property.
All right, you're coming in fast, brother. Benny Hansel, hey, good to speak to you, mate. When building an investment property, when is it classed as an investment to start claiming expenses? Great question.
So again, there was a little sneaky little trick which we used the year before last, and then they've changed that. So the olden rules, which were great, if the intention of the property that you were, say, building or purchasing was for an investment property, you could claim the interest, insurances, rates, whatever expenses you had, you could claim even while it was in build phase. Now you can only claim expenses on an investment property when it's available for rent. So let's say for your clients, mate, they've built a property, handover happens, bang, it's now available for rent. From that point forward, we're able to claim all the tax deduct or all those expenses as a tax deduction. From that point backwards, all those expenses get added to the cost base. So if a cost was $500,000, but they had to pay interest on a loan of $10,000, you know, over the period of time it's being built, from a cost purpose, it was $510,000. Yeah.
Yeah. So that means that you'll be able to. That's less that works out differently on the capital gains if you go and sell
When you
the
sell
property down the
Correct.
track.
Yeah.
Down the track.
So
I mean,
in that mindset, then over the life of a property, you can still claim the same amount. It's just when you can get access to that, you can claim, right?
Correct,
Yeah.
mate. Yeah.
and it's even inclusive. Sort of, we're talking about that specific date, Ben and Jace. When you submit your depreciation report, you've got to place on there when was the property available for rent, because then from a pro rata perspective on that current financial year's depreciation, they base it off that date as well.
Correct,
So it's actually highly scrutinised these days. But yeah, you could sort of claim the interest on the loan throughout the construction.
That was great, mate. We were getting clients that they might have been building this year and not settling till next year. They've got all these deductions and there's no income. They're going to get a big anyway. That's gone too, mate.
That's gone now as well. So this is another reason, ladies and gents, why you need a property savvy accountant who's literally got his head in the books. Come this time of year, so we can start to set ourselves up and have our expectations met for the oncoming financial year.
Yep.
Nicky Otto, great to have you on board here, Nick. Jace, on your Friday wrap-up, you talk about ways to save tax, but I've noticed a lot are geared to the older Aussies being able to draw on their super/recontribute. Do you have any tips for those of the younger end of the scale, beyond the basic deductions as far as work and property goes? So maybe we're talking about a bit of, salary sacrifice here and other sort of, deductions.
Yeah. Hey, Nicole. How you going? So I guess what I'll lead off with there is that any expense that you make, which is to generate assessable income, is a tax deduction. Now, the problem with tax deductions is that they're only beneficial up to your tax rate. So, for example, if you earn $100,000 a year and the tax rate is 39 cents in the dollar, and you go and spend $1,000, you don't get $1,000 back. You get the tax rate percentage back. So you spend $1,000, you get $390 back, being 39%. So that's one thing you've got to be careful of. The reason I've gone these couple of strategies for the older Australians is because these ones work before the end of 30 June. So we want to make sure anyone who's entitled to these, pull out a pension, recontribute as a contribution, and get a tax deduction for it and get a whole bunch of tax back is a great strategy to use before the end of the financial year. For younger guys, Robbie mentioned there, say salary sacrifice to super. If that's part of your wealth creation plan, you're going to put money into super at 15%, and it's going to save you your marginal rate of tax, say 39%. So you're getting like 40% of your money, or 40% more money working for you. So that's one good one. Otherwise, it's just any expense you make to generate your income is tax deductible. I'm never one to go out of my way to make a tax deduction because I'm only getting a small portion of it back. I don't get it all back. I only get a small portion of it back. And that's something you need to know because a lot of people get that confused. I spent $1,000, I'm going to get $1,000 back. No, mate, you're only going to get $390 back. It still costs you $610. So
yeah. It's the same reason why, sure, with the depreciation and the sort of the deductions that come with a brand new property, you've never heard from any of our mouths, ladies and gentlemen, that you should buy a brand new property for your tax deductions. You don't ever spend $1 to get 39 cents back. That's fucking dumb. But if you can get 39 cents back after spending that dollar for the right reasons, that's a good way. That's a no-brainer.
Yeah,
exactly. Right. Go for it, Dan. You can read out CJ wins, mate. Please.
Yeah, CJ sort of said there, might be getting a cheeky little trip overseas, so a bit of a cash injection. What's the best thing to do with the extra income while I'm over there? Do I just save it off to the side and decide what to do with it when I get home, or place it in the home loan offset account? Where is going to be best?
All right. So I've answered this question. I answered this question by telling this question, and I've done it 1,000 times. So for me, my job is, what are your objectives? What are the strategies available to you to help you achieve the objectives? What are the products we plug into the strategies to achieve the objectives? So I'm going to say, CJ, that you didn't go overseas and earn money. I'm going to say that you received a $250,000 inheritance from a great uncle you never knew you had. And you walk into my office and say, Jace, I'm going to grab 50 grand. I'm not going overseas because I can't, but I'm going to drive around the country and I'll come home when I run out of my 50, but I need you to invest my 200. And I say, yeah, mate, no worries at all. What do you want to do with your 200 when you get back? And you go, what do you mean? And I go, well, if you want to, talk to Robbie and Dan and the guys at Axon and buy a property, well, we're going to stick it into a term deposit or into an offset account because we can't afford the market to take a dive in the shortish time frame while you're away, and you're 200 to become anything less than 200 because you want to use as much as you can for your deposit. But if you say, mate, I'm fully set up, I'm debt free, on my investment properties, my home, whatever it is, I'm 40 years old, I want to turn this into as much as I can by the time I retire, well, then we want to invest it in an appropriate investment, aggressively growth oriented, all that sort of thing. So it's the same thing for you, CJ. What do you want to do with the money when you come home, mate? If you want to go and buy another property, then preservation of capital is your objective. We'll put it into an offset account if you've got one, because you're going to save a few percent interest as opposed to a term deposit where you're going to earn 0.5% interest. If it's just long-term wealth creation, then we're going to talk about, okay, what's the appropriate place to invest that money? Is it in another property? Is it in a managed fund? Is it investing into super? Whatever it is, depends on your objectives.
Yeah, at the end of the day, it's almost the whole thing we're talking about. And Dane, you've got a financial planning background yourself, and I don't envy the situation, fellas, that you're in when you have clients come to you. I'm like, what should I do with the money? Because I'll just grab something for you. Hang on.
The crystal ball.
I got one too. I won't have. You got one too. So yeah, like it really is just focusing on what are the strategies available to you, and you pick one that suits your risk profile and what it is you're trying to achieve, and you fucking have a punt. That's what it is.
Yeah.
You have that sort of that crack. So
yeah. Quick question from me, Jace, I suppose, before we do jump into, I suppose, your presentation. I know there's a lot of questions there, but I know you've also got some great content to come through. The ATO always release before tax time comes around exactly what they're like going to really hone in on this year, where they're going to pay some special attention. What have you heard, and what are we expecting to see this year, and where should people definitely not be trying to pull the wool over the ATO's eyes?
Mate, you know what? I read this today, and right at this very minute, I'm having a blank. I literally read these points today, and I've drawn a blank. So, Robbie, ask another question, mate, while this comes back to me.
All right, no dramas. Dane, can you go ahead and ask that question from Will, please, about making renovations and stuff?
Yeah, Jace. So you've built a new investment, and after a couple of years, you renovate it, make additions to keep competitive. Can you claim the tax depreciation?
So, yeah, okay, great question. Basically, it depends. You're looking at either a repair or repairs or improvements is what we're looking at. If, for example, you've gone in after a tenant's moved out and the paint's peeling off the walls, and you've got to, give it a really nice clean up, and it costs you a few $1,000s, that's a repair. Yeah, that's a deduction that you get straight away. You're not depreciating it, you're getting a tax deduction for it. If you drive past it and you look at the house across the road and they've got this really nice big brick fence and you've got this wooden fence that you got to keep painting, and you go, you know what, I reckon if we put a nice big fence up there, it might cost $15,000, but it's going to be a lot safer, it looks more appealing, then that's an improvement. So that's a capital improvement, which again gets added to the cost base. So if you're improving the property, so you're not, fixing up the back shed, you're actually installing a $25,000, 6x6 shed or whatever it is. If you're making improvements, it's capital and it gets added to the cost. So it costs you $500, you've gone and spent $20 on improvements. It's $520 when you sell it in the future. It's a cost base of $520, not $500. If you've just gone and fixed things / repaired things, then you get a deduction for the cost of repairing things back to original condition.
Yeah, and is that like on that same percentage? So say it costs you $1,000 to repaint the house
at your marginal rate of tax, mate.
39 cents, back in the dollar, whatever it is.
Yep, correct.
Okay, great. So it doesn't go into the whole sort of depreciation thing. You get that immediate claim back because you have now
the repairs.
Yeah, great. Yeah, prepared.
Yeah.
On that sort of point here, Matty Riley, got your email today, brother, as you know, so I've got your little proposal. We'll get back to that soon. Would you mind chatting about how depreciation impacts the capital gains tax? Obviously, we've seen, I heard you talk about the cost base here, etc.
Yep.
Tell us how that might work, mate.
For example, so when you do your depreciation report, there's two forms of depreciation. So you guys that have got an investment property, go down to the diminishing value section of it and have a look at it. You've got depreciation of the assets and depreciation of the building. So the building you can write off at 2.5% a year over 40 years. So let's assume you own this property for those 40 years and it costs you $200,000 to build the property. 200,000 divided by 4 is $5,000 a year. So every year you claim $5,000 as a deduction every year that you claim that $5,000, you're reducing the cost base by $5,000. So if you did that for 40 years, you bought the place for $500,000, you sold it for $2 million in 40 years' time, but you've claimed that $5,000 a year, you've already claimed the $200,000. So now when we go and sell the property, we're saying it only cost us $300 because we've written off the $200,000 over the 40 years. So it does come off the actual purchase price and affect us down the track. But what it does is allows us to cash flow the property whilst we've got it.
Correct.
Yeah.
Remember that rent and tax are just holding strategies. So that the fact that you do get, $6,000-7,000 back in tax generically for the first couple of years, if you are using the diminishing value method, depending on a few parameters there, it certainly does help the cash flow of the property a lot, which is really cool. Josh Oates has got a question. How is my tax affected if I own an investment property that is negatively geared?
Yep.
That's the whole point.
Exactly, mate. Yeah. So I'll use an example. Say, for instance, you've got your income from your employment and you earn $100,000 a year. And then you've gone and bought an investment property. It earns income of rent of $20,000, interest and rates and insurance and repairs, and all your expenses are, say, $15,000. So from a cash flow point of view, let's just say it's $5,000 a year positively geared, but you've gone and done the depreciation report, and in the first year, you're going to get a $15,000 depreciation. That adds on to the expenses. So now you've got $20,000 income, $30,000 of expenses. So when we go back to your tax return, your $100,000 income is then minus $10,000 of expenses. So your taxable income is $90,000. Tax on $100,000 was, say, $23,900. Tax on $90,000 is, say, $20,000, $3,900 difference. So I just quickly made up the 39%. The $10,000 at that tax rate is 39%. So you get a 39% deduction. You're going to get $3,900 back. So that's how that works.
Yeah. Happy days. That's good. Yeah. I mean, ultimately, we want to get to a point where our property portfolio is positively geared, where we're getting more income for what the expenses are. Because over time, that's what's going to create what? Passive income.
Why wouldn't you want 20 of those?
That's what we're trying to get to, So it's okay, Josh, in our opinion, to have a property in the first few years where it is slightly negatively geared, but then when you get your tax return back, it's positive cash flow. So that's a set and forget self-licking ice cream. Happy days. But over time, as the property goes up in value and you get extra rent return, you want it to become positively geared because that's going to replace your income when you choose to stop exchanging your time for your employer's money. Jace, is that all correct?
Bang, mate. Boom.
There we go. Hey, and just one final question, because I do want to know if you to bring the slides up for Jace, please. This has been a great little intro, by the way. What are we fucking halfway through? We haven't even shown the slides yet. Such is the interest as far as this topic goes, right? Are there any tax benefits attached to the first home owners grant, Jace, quickly?
Not necessarily tax benefits, mate. It's an incentive. So, the government issues these incentives to either stimulate, or what's the opposite of stimulate? Deflate, slow down the economy. Okay, so they issue the first home owners grant to help people to be able to afford to get into their own home. So that there's no tax incentives or tax benefit. It's more so an incentive that can help you get in there. So here's the deal, right? And if you listen to my Friday wrap, you'll know what I'm about here. Everyone, and again, mate, except for your clients, you guys are an anomaly. Every single Australian spends everything they earn, okay? So when the government gives $700 to every Australian, and we all go, what the fucking hell? That's like $1 billion dollars. Where do they get this money from? Mate, everyone goes and spends it. So what happens is, one, the government gets the GST 10% back instantly. Two, it keeps people in jobs and it gives them money that they get paid. And because everyone spends all their money, they go out and spend their money. But the government gets their money back like in a matter of months. I shouldn't drop names here. Maybe I won't. I play golf at a golf course down here on the Gold Coast called the Grand, and it's a course of very, very successful business people. And I'm not one of them yet, but I'm hanging out with them to try and join the club.
Of course you are, mate.
But, mate, I was chatting to a very wealthy man. He's worth about $500 million. And he used to know, well, he didn't used to, he knows John Howard very well. And I was having this exact chat, and he goes to me, why do you think they do it? And I just said what I said. He goes, exactly right. And he goes, mate, John Howard used to say the money comes back in about 4 months. Yeah, and then he talked about having having people on Centrelink. Why are we paying so much in Centrelink? He goes, mate, because it's cheaper to give them money than to look after them when they're in jail. You know, that's why they put people on Centrelink. That was John, because that's the alternative. These guys are going to end up in. I mean, I guess it's a big wide net he's cast there, but his whole thing was, if people aren't getting those benefits, where else are they going to get money from? It's cheaper to give out that money than it is, and he actually gave me the numbers. But mate, the incentives are used, so tax rates, and you'll see on one of the slides, which I'm going to fly through when we get to them, you'll see on one of the slides the changes in tax rates from last year. So the government used, that's called fiscal policy. They used the tax rates, a reduction or an increase in tax rates, a reduction or increase in interest rates, and cash bursts like this. Like last year in COVID, you got money from being an employer. I got money from being an employer to help people, to keep our staff in jobs. So they're going to go out and spend money in the economy because that's what people do.
I think what it was, we had BAS deductions. We didn't have to pay as much money on our BAS.
It was the pay as you go withholding, mate. Yeah, 100%.
Yeah. So that's good. All right, Noah, thank you so much, mate. You've been your bloody wealth of information, and certainly Nicky Otto, we're not ignoring you there, mate. But Jason's got a specific slide that's going to cover off on that stuff.
Yeah, Nicky Otto's just given Jace the answer: double dipping expenses, rental properties, capital gains tax from crypto. They're the big things from the ATO.
Oh, great.
Thank you.
Crypto.
Great.
Crypto. Dane's favorite crypto. No, I mean, Jace, when he's talking about the anomalies that are our clients, Dane and I started laughing because it's like, yeah, they better be saving money. And if they're not saving money, you let us know so we can ring them and make sure their savings is on track.
Yeah, totally. All right, Noah, bring up those slides, please, my dear. This would be great.
All right, we're going to go through these pretty
Over to you, champion.
Yeah.
Noah's just
Noah's controlling this for me because I'm a bit of an IT numpty. So, yeah, just to that next slide just quickly, Noah. So this is a general advice warning. So I'm going to talk about a couple of strategies at the end. So basically what that slide says, I was never here and I didn't say anything. Next slide, please, Noah. All right. It's a bit small. I apologise. But this is the current tax rate. So in Australia, we have what you may have heard about as being our marginal rate of tax system. So the first 0 to 18,200, you don't pay any tax. I'm 41. When I started out as an accountant, it was 0 to 6,000 was the 0% rate. It's now 0 to 18,200. This year, 18,000 to 45,000 is 19 cents. And so before, where you can see at 18,000 to 37,000 last year was the 19 cent rate. So you can see that they've changed it from a 37,000 ceiling up to a $45,000 ceiling where the 19% bracket starts. Then 45 to 120, and this is where I was getting my numbers even wrong from last year, or this is now this year. 45 to 120 is 32.5%. 120 to 180, 37 cents. And I was using that 39% mark before, which is, plus 2% Medicare. So one other thing for you guys to note, Axon clients, generally military people, are not paying the Medicare levy. And then over 180 at 45 cents in the dollar. So one thing on this slide, people, as a takeaway, generally, or not generally, but a lot of people think, if I earn $100,000, I'm paying, 32.5% on all my money. No, I'm not. The first 18,000 is tax-free. 18,000 to 45,000 is 19 cents. 45. So it's the marginal rate of tax. So that's the current year tax return or income tax rates. And as you can see, I talked about the government using incentives or using tax rates. People are going to get a bit more back than they would have last year because those margins are scaled down. Any questions as we go, please ask. But next slide, please. Noah. All right, that is super small. I won't even expect you're going to try and read it, but I know what's on there. So basically, when it comes to your individual tax return, you've got your income and you've got your expenses, and then you've got your schedules such as a tax return. So income, is things like your income from your employment. You don't get a group certificate anymore. It's all done through, Xero or back-end reporting. Single touch payroll is the word we use. But you're getting your income from your wage. You're getting your income from investments. You're getting your income from superannuation, like pension schemes, or some of the military guys are on, say, Class A pensions. That's all your income. So if we start at the top, we start with our income. Generally, it's going to be employment. It's going to be some interest. It's going to be some dividends, and we'll go from there. As we go along, Noah, we go over to deductions. So,
can I just stop you for a second, mate? Please rest assured, ladies and gents, we will put these checklists in a little link that you guys are all going to get. So don't worry about it. That's a little bit small. We'll see. And Noah's going to remove a little comment there, so we got the full screen for us.
Yeah, cool. So deductions. So again, these are related to your employment. There's not deductions related to investment property. These are deductions related to your employment. So you've got your motor vehicle expenses. So you can claim travel, or you can claim motor vehicle expenses when you're using your car for work purposes. We'll talk about home office in a minute, because that one's now its own little slide because of everybody's now working from home a lot more than they used to. If you make donations, if you've got a uniform that you wash, if you have a mobile phone or internet that you use for work purposes, your accounting fees. Like I said at the start, any expense that you make, to generate assessable income is a tax deduction. I had to go, well, I didn't have to, but I went last week to a year-end tax planning day, about the new rules and the new strategies and everything. It cost me $500. That's a tax deduction because it's based for me to benefit me to do my job. If it was, about, say, property development, and I've got my office as an investment property, I've got my home, I'm not a property developer, that's not really deductible. But if it was property development and the tax effects and that sort of stuff that I need to help my clients, it is deductible. So, if the expense relates to the generating of your income, it's deductible. If it's something that you just want to know about, the property development, life, then it's not deductible if you're not a property developer. Noah.
Next slide.
All right. So then we get more to specifics of, the ADF. So on that slide there, we've got car expenses. So I mentioned before, there's two ways to claim your car expenses. You can do one as the logbook. You can do one as a cents per kilometre. So the logbook is if you're doing a lot of work-related travel, the cents per kilometre, you can claim up to 5,000 Ks of travel. So it's not, you're not doing as much in the logbook. In the logbook, for 12 weeks, you keep a logbook and you say, every kilometre you do, it was work-related or it was personal. At the end of 12 weeks, you've done 10,000 Ks, 6,000 of work, 4,000 is personal, you claim 60%. So fuel, insurance, registration, servicing, whatever it is, interest on your loan, 60% is deducted. So you get out to the end of the year and you spent 20 grand, 60%, you claim a $12,000 tax deduction. If you're not doing that much, but you get to work and you've got to go to the mail or you've got to go and see a client or whatever, and you go, look, and I did 3,200 kilometers, I think the rate's gone to 72 cents. So you claim 72 cents of the kilometers up to 5,000 Ks. One of those ones there is fitness expenses. So if your military role is well over and above the requirement of just general fitness, you can claim things like fitness. Self-education, if you've got courses that you must do for the continual professional development, what I call it, CPD, that stuff's tax deductible. Home office we're going to talk about in a minute. Other things like sunscreen and sunglasses and that sort of stuff if you're outside. Protective clothing, mess fees, the stuff that you need if you go away that you've got to buy, that's all deductible. So that'll be a good slide for you guys to have a closer look at, specific to you and your industry. As we go on, please, Noah. And then we've got the investment property. So bringing it from ADF personnel and their job to actually having an investment property. Again, it's the same thing as you as an individual. We've got our income. Our income is just our rent income. We're not getting too many other forms of income for an investment property, just rent income. And then we've got all of our deductions. So interest on your loan is going to be a big one. Rates is going to be a big one. Repairs and maintenance, if you've got to make them, going to be a big one. Agents, management fees, going to be a big one. Depreciation, we've talked about. There's the two forms of depreciation: the capital works deduction, which is the actual property, and then the depreciation of your furniture and your fittings and things like that. So there's those two forms of deductions. Gardening, lawn mowing, there's those sort of things. Any expense in and around that property, are deductible against the income. So I guess a couple of things on that. You can be in a situation where you're just straight positively geared. Your taxable income from your property is positive, even after your depreciation. You can be in a situation where you can be completely negatively geared. It costs you money to own it, and it's fully negatively geared. Of course it is, if it's costing you money. Where on the flip side, you can be in a situation where it can be positively cash flowed, as in the income is 20 grand and the expenses are 15 grand or whatever they are, less than 20. But when you add your depreciation, your non-cash expenses onto the expenses, it takes you to a negatively geared component. So at some point in time, you might be in a situation where you're positive from a cash point of view and you're getting a tax refund at the same time. That's a pretty cool little spot where you might find yourself at some point in time. So that's one. And then, all right, working from home. So this became a big deal last year thanks to COVID. Generally, it's not really a great deduction. It's 52 cents per hour you can claim. So it doesn't add up to a lot of money, even if you are claiming that you're working from home full time. 40 hours a week, 52, a couple of $100 a week. It's not a huge amount of a deduction. But one thing to note is that because of COVID, it's supposed to finish at the end of this year, but I assume they'll probably take it on, because COVID is here for a while longer, I'd say, where they bring out this 80 cents per hour rate. Now, the 80 cents per hour covers everything to do with you working from home. The 52 cent per hour covers everything, but mainly you can see those two red crosses there, the phone and the internet expenses. So chances are you spend $100 a month on your phone and internet, and if, like for me, it's 100% work related, and I know for you guys, Dan, Robbie, pretty much the same. That's a $1,200 deduction that you're going to get at $100 a month. So for me, I will be claiming the 52 cents and then claiming the actual percentage of my phone and internet on that, and that's what that bottom part down the tip home office running expenses. 52% does not include phone, internet, that sort of thing. So most people are better off doing the 52 cents when they've got the phone and internet, things like that. Noah. All right, so I wanted to talk about a few of my favorite strategies in and around tax time. So I'm going to jump to number 2 there because it's an absolute cracker. Basically, what they've done is, again, it's an incentive. So they've allowed people who want to buy their first home to contribute extra money into super and then pull out up to $50,000 of those extra contributions back out of super. So let's consider the situation. I'm going to use that 100 grand and the 39 cents scenario. The person who earns $100,000 pays tax at 39 cents. So that's giving them $61,000, in their own pocket. So then they want to save for a home with that $61,000, whatever it was. That's where their savings come from. If they're saving for their own, it's not an investment property, it's their own home, they can salary sacrifice. So their employer puts in $10,000 into super. They've got a cap moving forward of $27,500. So they can contribute $17,500 a year into super at a 15% bracket, not 39% of their own money, and get out up to $50,000 of their extra contributions when they've got it. So like I said earlier, they're getting 40% more working for them. So they're going to be able to save for their first home twice as quick under that scenario. The TTR, so this is what Nicole was talking about back at the start. A people who are over age 60, they can turn their super into pension mode, draw out money tax-free, recontribute back into super, get a tax deduction for it. There's a whole strategy around that one. Contributing to super, which is what I said earlier, Nicole, for the younger guys, I talk about debt reduction and wealth creation. Wealth creation is, as much as I sort of hate to say it, especially for young guys, I'm not really on board with it, but making contributions to super is the best use of your money from a numbers point of view for what I've just mentioned. You get so much more working for you than it's working for you in a concessionally taxed environment. So they are my three sort of favourite strategies in and around this little area. And
Jason, if I can butt in for a second, as Benny Hinton's certainly put in there, the rules around the ADF super and the MSBS are certainly different to the normal sort of corporate one.
Sorry, mate. 100%. So this would be more like if you've got a partner, like you're military based. If your partner is, not, they can do it though. So they can capitalize on this strategy for them, like the husbands or the wives. Yeah, 100%. Yeah.
Another quick question there from Luke Hughes about the mining of what's he said? How is mining crypto treated as income?
Mate, I'm going to get my head around crypto this year because it's going to be big. I'll be honest, mate, I'm not 100% sure yet. I'm looking at it going, it's like anything else. It's taxable income as it's realised. So that's what I'm assuming is going to be the case. But excuse me, I'm not 100% sure, mate. It's kind of just taken off this year. So I've not done a single tax return before where crypto has been involved. Whereas this year, it's going to be game on. I know that for a fact. I already know.
There's a couple of other guys there as well. Sort of Brad Greeny, thanks for joining us, mate. He's sort of gone back to Luke saying, look, mining is taxed as income tax, the same way as receiving a dividend from a share or from staking crypto. So there's certainly there's a few bits and pieces there about how it's all going to work. But it's certainly the focus on crypto has never been the same. I spoke to a mate of mine about 6 months ago when it was sort of going really, really well. He's like, mate, have you seen the crypto price now? It's like fucking $85,000-$90,000. I said, you were into that crypto stuff, doing stuff on the dark web back in the day. He goes, I said, how many of you still got left? He's like, 0. And I'm like, oh, sorry.
Yeah, mate, I'm not across it at all. It annoys the hell out of me for a whole bunch of reasons. I won't get into tonight.
You can see there, ladies and gents, that we'll just put those exact little checklists there that Jace went through on the shared screen. So they're ready for you guys to consume straight away. That's all good. Certainly keep your questions coming through. But Jace, let's sort of spend the last 10 minutes or so, because it's like saving tax, optimizing tax, having super work for you in a certain way is all well and good. But at the end of the day, no one ever got rich by trying to save the amount of tax that they're paying.
Mate,
and I guess yes.
Yeah, so I was going to say it's a simple part of a much bigger picture. It has to play its part, but like you just said, mate, you don't get rich by saving tax. So this is what we sort of talk about. We've created the Your Wealth, Your Way process. And, mate, I spoke to your guys about it October last year. Last year. And we run, same as you, I probably pinched it from you, the name, the Discovery Session. And so what we've done, mate, any of you guys who have not been through a Discovery Session, you must sign me up for a Discovery Session and we'll get you one done. Get this, mate. It's freaking amazing. So we'll put in all of your information. So we'll put in your home, your super, your money in the bank, your loans, your interest rates, your repayments, all this stuff. And this has been created on an Excel document. And from that one page, it will print out a report for you instantly saying this is how, based on our assumptions, the future is going to play out. So if your income is this and it increases with inflation and your contribution to super are this is how much you're going to end up with in super. This is how much your home is going to be. This is when your invested property is going to be paid off. This is what your home loan, it just instantly, it's there and tells you. And then we go through this process where we talk about debt reduction and wealth creation. And, again, not really the excellent clients, but but like everybody else. But in terms of debt reduction, one of the best strategies is debt consolidation, because I can't tell you the amount of people where I'll talk to them and say, hey, do you have any money you can allocate towards wealth creation? Like, nah, mate, we live week to week. We don't have any cash flow. And then you talk to them 5 minutes later and they're just explaining to me the new car they've just bought, which cost them $800 a month. I'm like, I didn't think you had any cash flow. And like, oh, well, we do for this. And so consolidating debt. So when you look at people's bigger picture and you go, look, your home loan, as an example, costs you $2,500 a month, and your car loan is this, and your overdue credit card is that, and this is going to be paid off in 2 years and 4 years and 21 years. If you can consolidate all that debt together, and you can show people that they can pay the whole lot off in, say, 12 years, right? And so then we talk to them about, listen, you need to make decisions based on the knowledge of your future self. Imagine if you were 12 years down the track and you'd taken this information on board now and acted on it. How would you feel when you're debt-free, knowing that you would have otherwise had 11 or 12 or 13 years left to go? You bloody feel amazing. How do you feel if you don't? You feel like the knucklehead that you are. So, that's one thing when we talk about debt reduction. And because we build into this strategy, you've got the debt reduction allocation, you've got the wealth creation allocation. Once you've paid off that debt 12 years sooner, boom, we're now over to wealth creation. So then we're using that money to build wealth, however it is, salary sacrifice in the super, building money outside of super. So then we come across to the wealth creation tab. And again, mate, one of my things when I talk to people about is to say, do you have any allocation, of debt reduction? And it's going through this process where, I've done it, I'd say 1,000 times. I've done it hundreds and hundreds of times, where you start to sort of see patterns in people. And so what we want to do from the very beginning, we say, how much do you want to live off when you retire? How much do you need to accumulate to generate the income? And are you on track? Once we go through this process and we finish with a few of the strategies we'd use, the modeling is recreated instantly and shows the impact of a couple of small changes along the way. So people are going to see the benefit of what we can provide in this first discovery session, on an Excel tool. So, mate, it is. Can I just
simplify what you just said? That crystal ball that we all gaffed at half an hour ago when I said, the biggest fear that people have is the decisions they make in the here and now. What impact is that going to have in the future?
Yeah.
Be that investment, be that debt reduction, be that tax minimization, fucking whatever.
Yeah.
Yeah.
If I just take away what you just told me, you've now got a software modeling tool that's based off a couple of very simple inputs and assumptions, which allows that modeling to occur so people can see the future.
That's it, mate.
Amazing. Dan, we just cut you off there.
I was about to say, Chris Williams has already signed himself up. Good news is, Chris, in your success package, mate, you've already got that shit included for your next property. So you will be sitting down with Jace to be able to go through the full process, mate. Absolutely.
So just listen to what I just said then, ladies and gents. We're now Jace, and correct me if I'm wrong, buddy. I know you've done a lot of work in making sure that this is highly specialised to, your business, your wealth corporation, hence your wealth, your way. No one else has got this. No one else is.
We built it. I mean, there are modelling things out there, but I don't know of anyone that's got a process where you can plug in what you're doing right now and generate an output, and then make changes on different tabs and generate a new output. And so we show in dollars, and it all comes back, mate. It all comes back to the end. I want to live off $90,000 a year, and and I want to retire at age 60, and it says that you need 1.5, whatever the number is, right? And so now we're going to show you, based on what these actions are, what this is going to become. Yeah. So then we can then go and play with it and go, well, hang on a minute, I maybe want to earn 120 grand a year, or I want to retire at 55, or maybe I need to retire at 63. And so mate, I said this to you, and you said, well, this is what we do. My job is to give you clarity of what the future looks like and peace of mind to know that you're doing all the right things all the way along the way. Simple as that, mate. And the tool is built to do that. Yeah.
I'm just laughing at CJ's comment there, Noah, if you can put it up there. Our session with Jace was so great, I was nearly in tears learning that I wasn't a total fuck up financially. Such clarity and guidance, and we have done just about every single thing he told us to do. So, I mean,
what haven't you done?
Yeah. Why is there still something you haven't done?
There has been dozens of other clients that I've spoken to. I'm like, hey, how'd your session go with Jace? And then it's like, oh, so good. We've now got clarity that we don't actually have to make massive changes in the here and now. We can tweak a few things over the next 10, 15, 20 years, and we're actually going to be okay. I'm like, well, did you actually inject the fact that you're about to buy your second investment property as well? Because that's going to have a marked difference. We're like, we haven't even spoken to him about that yet. I'm like, well, not only is your future going to be okay, you're going to be totally fine.
Robbie,
and the level of peace of mind you provide clients, mate, is phenomenal. CJ is fucking a hard-nosed bloody, RAF senior NCO as a fucking dog handler, not someone that you bring to tears easily. So you've done an amazing job there, mate. Well done.
So no, thank you, mate. There's two things I need to do. First of all, Noah, can you bring up Con's question? Because I'm pretty impressed with this. Con, does the modelling consider MSBS? Yes, mate, it does. It's got its own special, because we're dealing with so many Axon clients who've actually built in the MSBS calculators to it. So I wanted to bring up that.
So
it's freaking amazing. Robbie, you just did this, mate. You just waved your hand, right? And so I'm going to say you pinched that from me, because all the guys in the office are reading Atomic Habits, yeah? And so what you talked about, it doesn't matter where you are. What matters is the trajectory you're on. And so we're all here. We're all today. There's nothing we can do about it. We can't go backwards. We're all here. It's the actions we take on a day-to-day basis that determine where we will become in the future. So it doesn't matter where we're at. It matters the trajectory. So if somebody wants to save $500 a month that they've never done, their trajectory is going to go up. If somebody wants to spend an extra $500 on McDonald's every day, a week, month, whatever, their trajectory is going to go down. So it's the actions we take on a day-to-day basis that determine where we become, and those actions determine the trajectory. So you just did that, but yeah.
I'll do it every day, mate, because I know.
Mate, I've sat here for the hour just listening to you. Usually I fucking jaw off all session. But I love one of the things, and you always hear, and when people go, oh, like I'm younger, I don't really want to contribute more into my superannuation. I know the cap's going up to 27.5 grand, but I think a alignment change, and when you sort of spoke about it, once it goes in there, the earnings on that are only at 15 cents. So if you keep it out and you're trying to earn outside and you're already up at a high income. So I think when people sort of go, okay, I want to take control of my super, and I see stuff going in there that's yielding me a better result, I think people will take it in at a younger age. Do you agree?
Mate, the military clients, the amount of money that they've got in super is mind-boggling from a young age. Like the rest of the country needs to do super the way that military does super. They contribute extra money. They force you to put an extra 5% in. Super is the best place to build wealth. So you've got to get your head around the fact that super is a structure, just like a company is or a trust is for tax purposes or for business asset protection or for a business. Super is a structure. It's a tax effective structure because it's there to incentivize us to build wealth so we'll look after ourselves in retirement, not relying on the age pension. If every Australian was forced to put an extra 5% in, there wouldn't need to be an age pension once the current 20-year-olds get to age 60, because they will have accumulated so much money, just like military people do. So it's a bit of a hard one to get your head around, though, because if you're 20 years old, you want to build wealth outside. So part of your wealth, this is another beauty of this your wealth, these enhancements that we've made. We show you that if you build wealth outside of super, if you want to retire earlier, the new discovery tool will tell you from which age you can retire based on the outside of super wealth that's generated and what it's become. So then we know how much we can put into super and how much we keep out of super. You've got to get on it.
The clarity of the numbers at the time.
Clarity, yeah.
It's bloody, all they're after is some short run success or some short run pleasure, I should say, rather than long term bloody glory that they're going to have by sitting their money in their super.
Yeah, a little bit over a long time can yield extraordinary results, mate. Just a little bit.
Oh, Dom Grigor, the eighth wonder of the world, the man. Bloody oath, that is so true. Well, do you know what's even better, Dom, is compounding growth. Compounding interest is fine if you're getting that, year-on-year interest from a share market perspective. But when you get compounding growth, brother, that's when the real magic happens.
Yeah, and let me add to that, Robbie. So again, with our Friday wraps 2 or 3 weeks ago, we called it the boring end of the curve. So compounding interest, compounding growth is great, in year 20, in year 21, all the way through, because that's when it's doing its thing and working magic. You've got to start. If you put away $250 a month for 40 years, you put away $3,000 in the first year, you got $6,000, maybe a bit of interest, whatever, in year 10, you might have, $33,000, well, I put 30 grand, I got 33, whatever, it'll be a bit more than that. But you know what I mean? In year 30, you might have, $550,000, and the next year you put your $3,000 in and you've got $610,000. And so all of a sudden the growth every year, is massive. So you have to go through the boring end of the curve to get to this exciting end of the curve. And here's the problem. If you miss out on year one, if you don't start for 1 year, you don't miss out on 1 year of the boring end. You miss out on year 30 at the end, on that exciting end. So you must start now.
I'm fucking levitating off my chair.
Yes, take off.
That is good.
You know what?
That is good.
I need to get off this Facebook Live and go.
So do I.
Me
Hey,
too.
Chris Lowry, just quickly, Chris Lowry, that's an excellent question, as I'm sure many other people have got some others. That will take a few minutes to explain. We've got other clients we need to go to right now. Jace at Your Wealth Corporation or YWC, just hit us up on the back channel, mate. We'll put you in touch with Jace if you're not already, and he'll answer that question for you and more.
Chris, I'll intro you to Jace over the next couple of days, man. We need to link up when I get back from
Thank you, brother. As always, that was fucking great. Well done, Dane. Well done, Dan. Thank you, Noah, on the back channel. Thanks, everyone, for listening. Have a great night.